You spend 40 hours a week sweating, stressing, and trading your finite time on Earth for a paycheck. And what do you actually get for all that physical labor? A momentary beep and a tiny change to a digital number on a screen. We mostly operate under a polite assumption that those digital numbers mean something real. That somewhere, buried deep in a heavily guarded mountain, there is a tangible pile of wealth perfectly matching the balance on your phone. For a long time, that assumption was true. Under the historical gold standard, paper bills and bank ledgers were literally receipts for a physical asset. The wealth was heavy, yellow, and stacked in a vault. But that physical backing is gone. Today, our money is entirely fiat. It is a manufactured product, printed by decree, and backed by zero precious metals. If the currency is unmoored from physical reality, we have to ask why billions of people still surrender their energy and their labor to acquire it. This system functions because of a collective agreement to value these manufactured tokens over our own lifespans. It is a shared mental model that holds only as long as we all continue to participate in it. The value of fiat money begins with a very concrete demand. A government requires that taxes be paid exclusively in their specific designated currency. That requirement creates an immediate base-level demand for those specific numbers. To manage that official currency, the state authorizes a central bank. This institution acts as the supreme authority over the financial system, setting the baseline rules for how many units exist and how much they cost to borrow. But if you think the central bank's main job is running printing presses, you're missing the scale of the system. Physical printed cash makes up only a tiny fraction of the global money supply. The overwhelming majority of the money you earn, spend, and save doesn't exist in the physical world. It lives as digital entries on a massive, interconnected network of commercial bank databases. Instead of physically printing the money in your pocket, the central bank calibrates the vast digital ledger that dictates how commercial banks operate. To see how those commercial banks actually operate, look at what happens when you go to one to secure a mortgage for a house. Most people assume the bank goes into a vault, gathers up the savings deposited by other customers, and slides that pile of cash across the desk to you. On the bank's blank digital ledger, they don't move existing money. They type it into existence. Simultaneously, a positive credit and equal negative debt appear. Your obligation to pay it back generates this new money, which detaches and flows outward into the broader economy. This specific mechanic is called fractional reserve banking. It is the engine of modern economic expansion, allowing banks to generate capital that funds new businesses, builds new homes, and creates infrastructure. This means that virtually every digital dollar currently existing in the global economy was born as someone else's debt. That simple morning coffee purchase triggers a micro-adjustment on the global debt ledger, shifting a tiny digital liability from your column to the coffee shop's. This diagram shows the macroeconomy as a living network of credits and debts, constantly expanding and contracting with every single transaction made by billions of people. Because this network lacks hard physical constraints, it relies entirely on collective human trust. If too many people default on those initial debts, or if panic sets in, the entire ledger can contract. But that lack of physical limits is also a strength. We aren't constrained by how fast we can dig gold out of the ground. The ledger allows for the coordination of global human effort and invention on a scale that was previously impossible. We have built a massive, invisible operating system for coordinating human labor, a technology that functions because we choose to wake up every day and maintain the ledger.